everyone, and welcome to a Modern Sales Pros event. I'm super excited to get started, but we'll give folks a couple more minutes to trickle in. I love to start things off with a little fun little icebreaker with our speakers here. And today's icebreaker, I'd love to know, Ryan and Graham, are you a morning person or a night person? And we'll start things off with Ryan.
I would say I'm definitely a night person. I probably average going to bed around midnight or a little bit after that every day.
Wow. Are you watching movies or on your phone, reading a little bit?
Probably a little bit, all of the above, I would say.
Oh,
Yeah.
nice, nice. Is it hard getting up in the morning, or are you pretty much just like really good at waking up and going about your day?
Coffee's the big one. As soon as I have that first cup of coffee, then I'm good to go.
Nice, me too. Graham, how about you?
There we go. Sorry, the mail is being delivered right now, which means my dogs are barking. In college, I was always a night guy. And then when I started working, I became a morning person kind of by necessity. But even still, I know this is a strange answer, but I tend to get my best work done in the middle of the day. I know there are people who are like, oh, I do my best work in the morning, or I do my best work after 10 p.m. I'm like from noon to 4 p.m. are like my peak hours. So my wife works at a horse barn, and she is up and out of the house by like 6 a.m. And so that usually gets me up early, but I'm not really productive until like 9 at the earliest, and then truly productive around noon.
Nice, very cool. I would like to say I am more of a morning person. I never used to be. I definitely was like Ryan, night owl on my phone up until like 2 a.m., just scrolling on Instagram or TikTok or Twitter. But since I moved out to the West Coast, now I'm in Vancouver, Canada. I am now a morning person, and I definitely have a morning routine, my coffee. Sometimes I'll get like a workout in. But yeah, definitely change in dynamic with where I used to be. Well, awesome. Thanks for sharing. I am super excited to dive into our topic today, CAC and Comp, a relationship worth exploring. But before we begin, I'm going to say a few words about the team at Modern Sales Pros. Hello, everyone. My name is Angelica. I'm one of the community event managers at MSP. And for those of you who are not familiar, Modern Sales Pros is the world's largest and highest quality community for those in sales management, sales leadership, sales and revenue operations, and enablement, aka our Modern Sales Pros. Our mission is to create an environment for our members to answer questions they struggle to solve on their own and help them to see around corners they may not know about. We do this through live sessions like the one you're at today, our online robust forum, and our quarterly summit, which we're coming back in April, so stay tuned for that. So if you're not already part of the MSP group, you'll be invited to join right after the event. Now, housekeeping. A few words on housekeeping. If you have a question for Graham and Ryan, please use the Q&A function at the top right-hand corner or use the chat, and also let us know where you're calling in from. And first and foremost, this event is being recorded, so if you have a colleague or friend that couldn't make it, don't worry, you'll be able to access the recording, the presentation, the key takeaways, and any resources and documents that we'll be mentioning throughout the presentation on the MSP website before the end of day. And today's event wouldn't be made possible without our sponsor, QuotaPath. QuotaPath helps sales teams design fully customized compensation plans, forecast commissions in real time, and surface insights in one easy-to-use dashboard. No more manual calculations or data entry. I'm going to drop their link in the chat to learn more about QuotaPath, and be sure to check out the booth for more information at the top right-hand corner. Now I'm going to pass it off to our speakers today, which I know Graham has a lovely presentation, so I'll stop sharing if you want to start sharing, Graham, and I'll come back for wrapping remarks.
Excellent. Let's do that. Share my screen. Hopefully we can get that going. There we go. Excellent. Hello, everybody. CAC and Comp, a relationship worth exploring. So I'm just going to quickly set the agenda, and then we will do introductions. So today's agenda, we're just going to do a quick introduction, talk through the state of the market currently, the impact on compensation plans and the impact of compensation plans. And then we're going to give you a few tips to avoid efficiency pitfalls. And then we do have the Q&A at the end. We do have the Q&A as well. I'll be keeping an eye on that. Feel free to ask questions throughout. if I feel like it makes sense to ask during the session, I'll interrupt myself or Ryan and ask those questions. But if not, if it doesn't make sense for us to talk about at that time, we'll talk about those at the end. So let's do quick introductions. Ryan, you want to give an introduction of who you are?
Yep. I'm the VP of Finance here at QuotaPath. Coming up on my 2-year anniversary here in a couple months. So I've been with the company for about 2 years, and we've raised 2 fundraising rounds during that time as well.
Excellent. And I have all kinds of different titles. I'm Graham Collins. I am our officially chief of staff, currently our interim head of sales, VP of sales, running our sales organization. I've been at QuotaPath for about 4.5 years now. As you can see, I had much shorter hair when my headshot was taken. I've got it pulled back, but I have quite long hair now and a mustache. But I have done all sorts of things at QuotaPath. I've done sales, account management, customer success, some rev ops. Before Ryan got here, a little finance, as scary as that is. He's probably been cleaning that up for a while. And a major function of what I do as well is I help our customers and prospective customers think through how to build compensation plans and how best to compensate their sales teams, sometimes themselves. So that is us. And Angelica gave us a quick lowdown of QuotaPath as well. Thank you for that, Angelica. But it's there. And then, of course, we do have the link in the chat and also the request demo with our sponsor at the top. So check that out as well. Awesome. Well, so for the beginning part here, most of this, I'll likely be leaning heavily on Ryan. But Ryan, one thing that we're going to be needing to talk about is the state of the market, the state of our current market, and this looming recession. I know that I saw a news update the other day, like America's biggest recession is upcoming in 6 months, and it always has been, or something like that. And so I'm curious to hear a little bit about that. And part of it is that we're making this shift from grow at all costs. First of all, grow at all costs from a sales perspective is that, like, you do things that don't scale. You close any deals you can, even if they're bad deals, or you have to give crazy discounting or whatever. What does growth at all costs mean for you from a finance perspective?
Yeah, I think it's, and this kind of goes back to really table setting on why CAC matters, why efficiency matters, why there's this renewed focus on some of these core KPIs of a business. Growth at all costs, to me, it's you're kind of looking the other way on how you're getting to growth, right? So maybe your CAC's inefficient, maybe your gross margins aren't where they should be, but it doesn't matter because you're growing, right? And in the boom market of 2020 and 2021, that's really all that mattered. And why was that all that mattered? Because that's what was driving valuations of businesses at that time. So given that growth was the primary valuation driver, that's all a lot of companies were focusing on. But, now move into an environment, you kind of touched on it, this looming quote unquote recession. We see interest rates start to creep up in the beginning of 21. That trend has continued into 22. Investors start to look at these businesses that were growing at all costs, and they're starting to ask that question, will these businesses ever reach profitability? Will they ever throw off positive cash flow? This bull market evolving into a bear market where now investors reprioritize the value of short-term profits, right? If they're able to go just invest in something risk-free, like a treasury bill, and get 4 or 5, maybe even 6%, why should they invest in your company, right? And take on that risk. Investors start to demand a lot more from their money, and then they're really going to demand more from their businesses, and they're going to start to ask that question, are you profitable? And that's something we always wrestle with because most startups are not at that stage yet, right? They're spending money to scale their operations up, scale their teams up. So they're not going to be throwing off cash yet or be able to show profitability on a P&L statement. So then the question is, well, will you ever become profitable? Do you have line of sight to profitability? And that's where these other kind of more up funnel metrics like, CAC and LTV and gross margin, if you start to show healthy signals on those metrics, you can start to make the argument of well, we do have a path to get profitable, right? And, there's just kind of this interesting phenomenon that's gone on over the last 2 years. And in finance, we see it. We talk to, the VC community a lot, and there's these kind of 2 big concepts that I think relate to what we're about to talk about. And there's this concept of default alive. So what do I mean by default alive? So this is something that was coined by Paul Graham. So a company has a path to become cash flow positive before their current cash runs out. So you're not dependent on any more outside capital. You control your own destiny. There's potentially no more dilution on your cap table. And I have a path to cash flow positive or to profitability. Then there's a concept. So that's default alive. Now let's talk about default investable.
Ryan, sorry, what is the default to live? Is that what you're
saying?
Sorry,
default alive, ALIVE. Sorry, alive.
Got it.
You are alive as a company, right? Then the
default
other concept.
Alive. I understand. Yeah, I was thinking default as like a, in a negative way, but you're saying like default as like the standard, I guess.
Right. And then the other concept, which was coined by David Sachs, is default investable, right? Are your metrics good enough to raise another fundraising round, even in the current environment, right? So in 2020, these two concepts there was a strong divergence between the two. And what do I mean by that? So companies could be extremely inefficient, but they're growing quickly enough that they're still default investable. And the metrics that investors were looking at to be investable was that growth, right? Growth at all costs. Well, as long as I'm default investable, I don't need to be default alive. I don't need to worry about cash flow profitability. But fast forward to 2022, and there's like these two concepts have now converged where the default investable, are you investable? Well, you need to be default alive to be investable, right? So now it's all one and the same. And that's what investors are looking at, right? So this old world of, growing at 100%, but you're doing it in an inefficient way. Now growing at 20% and getting to profitability is better than growing at 100% or 200% and burning a bunch of cash. That next fundraising round is not necessarily right around the corner, and you can't count on that. So it's going to be the survival of the quickest to take that hard medicine, right? And we've seen that in the markets with, a lot of big names right-sizing their cost structures with headcount reductions, restructurings, and freezes. We saw that with Google, Meta, Amazon, Microsoft, Salesforce, Twitter, like just name, you can pick a name out of a hat of the Fortune 500 tech companies, and they're all working on, well, that's one of the quickest ways to get to that, default alive, default investable. It's all one and the same now. To really get efficient is to cut your costs. But what we're going to talk about, yes, that's one path there, but how can you use other tools, maybe a compensation plan, maybe an incentive structure, right? How do you start to bake some of these concepts in other ways? Because cutting costs is one tool in your toolbox, but you have other tools there as well, and they all can continue to start to contribute to driving efficiency in the business.
Yeah, so that's great. And I know that we're going to be talking about like CAC payback and CAC being like one way to be default alive and therefore default investable would be to continue growing, but sustainably, and in a way that actually allows you to have a path towards profitability.
Yep. So we're looking at this slide, right? How your finance team measures the business. So there's, your traditional financial metrics, like something like gross margin, which is on a financial statement. It's on your income or P&L statement, right? And then, as we talked about, there's kind of these more up funnel metrics of, well, how do I know if a startup company or, this company has line of sight to profitability? And there's stuff like LTV we could look at, which is the average customer lifetime value across your entire base. There's something like CAC or customer acquisition cost, which is all of your sales and marketing expense in a period divided by the total number of new logos added in that same period. That's kind of the formulaic, definition of it. Really what it is how much does it cost to bring in a new customer? And then there's something like gross margin, which again, more of a traditional metric, but the difference between revenue and cost of sales, because, what money do you have left over to service the rest of your business, right? After you've spent the money to service your customers. There's plenty more we could choose from here, right? There's burn multiple, quick ratio, magic. There's, we call these the quote unquote like Moneyball style metrics to try to measure a business. But again, it's all trying to answer that question. Are you healthy? Do you have line of sight to profitability?
That's great. And I mean, the one that we are going to be talking more about is customer acquisition cost, or CAC. And those of you who heard us saying CAC at the beginning and didn't define it, apologies. I try to define things beforehand, but we didn't define that initially. But glad we have this defined here. And I think one of the major reasons that we're going to be talking about the customer acquisition cost as part of this next 45 minutes, looking at the list of attendees on this webinar, it's finance, rev ops, and sales leaders. And so that is one of the biggest driving factors. Now, a lot of those people also are probably overseeing account management or renewal business and customer success or onboarding. But when it comes to new business, tell me if I'm wrong here, but it seems like CAC is the most important component when it comes to new business. Is that right?
It's probably the most widely accepted efficiency metric, at least from a SaaS tech perspective, to measure new business efficiency.
Got it. Yeah. And that actually goes to the example that's on the next slide here, which is looking at and measuring the CAC payback. Can you talk through this chart a little bit? I know it's a lot of numbers, but I'd love to hear a little bit about this.
Yeah, so we talked about CAC on the previous slide, and that's just your customer acquisition cost. So how much does it cost to acquire a new logo or a new customer? There's also a concept of CAC payback, right? So how many months will it take for me to recuperate the money that I spent acquiring that customer, right? So this will depend on how much you're charging them, what's your ASP, what's your lifetime value of a customer, and we have what we call this a sensitivity matrix, and we have one of these built for kind of each of those key KPIs, and we use these internally, and it really helps the team or translates those formulas out to the team, and it really translates the sensitivity of what it takes to move the needle on each of these metrics. So you can see on this one, going along the y-axis there, we have your sales and marketing expense that includes account management. So if you're going to take the credit on the x-axis there for new business and upsell ARR, so if you're going to take the credit for upsell ARR, you also need to burden yourself with the team, whether that's a CSM team or an AM team that's acquiring that ARR, right? So we use this to translate to the team of like, hey, if you're going to hire another headcount on the new business team or the AM team, or we want to go launch a new marketing program, what is that going to do to CAC? And if we don't think that it can increase our new business and upsell ARR more than what we're spending, according to this chart, then that helps drive our decisions on like, are we going to make this investment, whether it's a new program or a new headcount or whatnot.
That's great. And from a new business sales perspective, I think that oftentimes what I hear is like, oh, we have a team of 10 who are selling $500,000 each per year. Well, we need to increase that to, we need to double that. So let's just double the size of the sales team. And that's kind of a fatal mistake a lot of the time, because you do you increase the amount that you're selling, but you are also increasing the cost. So that may not actually even benefit you in this CAC payback period. So I see that there's.
Yeah, it's important also to just understand the accounting that goes into this as well, right? So what is going into CAC and CAC payback? We said, it's all sales, all marketing, account management to the extent that they're contributing to expansion or upsell sales. All of that gets thrown into one. What about sales operations, right? Are the Slack licenses that your sales team are using, are those getting carved out and allocated to this metric, right? That's where you can, potentially game the metric a little bit. It's important to just be, however you're reporting it, be consistent so you can see movements, quarter over quarter, year over year, and you can actually measure progress. You want to be, including or excluding some expenses one period and then including or excluding them in another, because you're not going to know like if you're improving or not.
Got it. Yeah. Do you have and I know that's talked about a lot, do you have a rule of thumb when it comes to things to include and not include, or is your rule of thumb just be consistent?
Well, that first and foremost, be consistent. I would say then on the second point, materiality comes into this. So us, for example, we're not carving out the Slack licenses, right? We're probably just throwing all of those into G&A, and it's not burdening this metric. But Salesforce licenses, for example, or primary use is for sales. I would say like those should not be in G&A, and those should be hitting your sales. So you're kind of looking at how is the tool used? How much are we spending on it? Is that a material amount? And should we have that harder conversation of whether to include it or not? I think something like RevOps team, that's a trickier question, because they may spend 50% of their time fully supporting sales and marketing. Maybe 50% of their time is just supporting the rest of the business. Maybe they're doing product analytics, and helping your product management and engineering team. But understanding those, and if you want to do a high level swag to get a more accurate number, just be consistent.
Yeah. And I know that in some organizations, I've seen them go as specific as like snacks in the office divided by, the spend you have for snacks in the office divided by the number of employees times the number of sales employees. So I know that you can get very, very specific, but it sounds like for you, it's more about just consistency and getting the, and being consistent with it. Awesome. Well, so this is where I love talking about these is comp plans. So I talk a lot about comp plans, a lot about comp planning. Comp plans can often be seen as very costly, and especially from a finance perspective, because it's like, well, we already pay these people their base salary, plus now we have to pay them this additional incentive. I firmly believe that compensation plans can be a revenue driver. And not only can they be a revenue driver, but going back to some of those other things out there, like the gross margin and the lifetime value and whatnot, I believe that there are things you can do as part of the comp plan to improve those, not just necessarily CAC. And sometimes they might go against CAC, which is an interesting topic that I want to dive into a little bit with you. So when it comes to comp plans, one thing that I have been doing a lot of thinking about, a lot of talking about, is understanding what your ideal customer profile is. And part of that is because we just, over the past 6 or 7 months, have done a lot of research into what our ideal customer profile is internally. But on that point about grow at all costs, I had said closing bad deals, closing bad deals would be a grow at all costs, is identifying what a good deal is. And teaching your reps what a good deal is. So an ideal customer profile, just a quick definition, just describes best fit customers who buy quickly, rarely ask for discounts, tell their friends. One thing that isn't in here is renew or even expand. Now, from a sales perspective, I understand the importance of having a clearly defined ICP. Our close rate among ICP customers is twice that of our non-ICP customers, even more than that so far, over the past 4 months. So it's also shorter sales cycles generally. Not always, but on average, they are shorter sales cycles. So my reps can go through more of these. Sometimes they're higher ACVs. I'm curious to hear from a finance perspective. How do you think about ideal customer profile, and how does that impact when you think about CAC or each of those different metrics?
Yeah, that's close rates is a great one. And obviously from a sitting in a sales seat, Graham, you're going to obviously kind of think of that one. From a finance perspective, I think it's a lot of those KPIs that we just talked about. Is there a subset of customers that are best in class for those metrics? And then starting to double click and try to understand why. Why is this subset of customers my highest margin customers? Why is this subset of customers have the longest LTVs, right? And you have to do some level of customer segmentation on your reporting to start to see trends and understand, different patterns of customers and whether that's, they're all of our customers over a certain size follow in this pattern, or in a certain industry, or they're using a certain integration with my product, right? So what patterns of our best in class customers, and then how do we, build, our ICP, for lack of a better word, around it. And then what does that mean? Well, how do we build marketing programs around it? How do we target our sales teams to go attract those customers? Because we want more of the best in class to continue to improve those metrics.
Yeah, definitely. And from a new biz perspective, of course, oftentimes I'm thinking about close rate and sales cycle and average contract value. But oftentimes that can be deceiving. My previous company, we used to talk all about sports teams and how great sports teams were to sell into. I sold public relations software. Ryan and I actually worked together at that company as well. Sold public relations software, and it was always like, oh, sports teams. I personally sold a couple of sports teams. Those are our ICP. We need to go after all of those. Well, come to find out, those sports teams had a lot of turnover in their public relations departments. So we ended up churning most of those customers. They were a lot of work for our customer success team. So that impacted our gross margin. And we really just happened to get lucky with a few of them. But because they're sexy, big logos, we got excited about it and did a whole campaign around that. So you have to be a little bit impartial when looking at the ICP data and not just look at new business. Look at renewals, churns, expansion, cost to service, all of those different components for you to come up with what a true ICP is instead of what would be a fun and exciting ICP for you.
And it's not necessarily set in stone either, right? As your company, your product, your service evolves, you hopefully are opening up your aperture to the market and tackling more of the TAM. So your ICP can evolve along with it, right? Maybe starting out, the SMBs are easier to satisfy, right, when they first come in. The bigger enterprise level deals are going to be more skeptical of your product or service. But as your product or service continues to improve, you get your SOC 2 compliance, you start to add more functionality, you're able to tackle more use cases, that ICP can evolve and grow.
Yeah, which is an interesting question that actually came up in the Q&A just now, which is, as a startup, when is your data set large enough to trust the data? Like, when is your data set large enough on an ICP perspective and on a CAC perspective? And I mean, my take on, well, I don't know. Do you have a quick answer to that? There's no easy number, but
it's a great question. There's no easy number. I would just say you constantly are revisiting and recutting and refreshing the data as you learn more. And to the extent you start to see a different signal that challenges your preconceived notions before or whatever you settled on as an ICP, then maybe you start to key off of the more recent data. As early stage, I'm always going to be, whether it's a financial model or anything, I'm going to put a lot more weight on recency. So the last 3 months, for example, when I'm building a financial model, rather than like maybe this time last year or whatever. So I'm always looking at the latest and greatest data.
Yeah. And one pitfall that I see oftentimes specifically with ICP is that people determine, hey, this is our ICP. Our ICP is SaaS companies. And then they don't go after anything non-ICP, or we'll talk a little bit about comp plans, but like we change it so that you don't get paid for anything in non-ICP or what have you. That can be really dangerous because your ICP can shift over time. And so it's important to not exclusively, it's an ideal customer profile, not an exclusive customer profile. So ensuring that you're still out there talking to people who are not necessarily ICP.
Right. I agree.
And then there was a question about how ICP relates to SAM and TAM. I often hear people talk about how their ICP is their TAM, and I think that's a mistake. ICP, and SAM is kind of a newer terminology, I suppose, but the way I see it is like TAM is your total addressable market, anybody you could possibly sell to. Your SAM is serviceable addressable market, which is to say, like, hey, it works for this industry. And then ICP is even a subset of that, a subset of those potential customers, which is like, these are our ideal customers. And so I don't know what portion of, or if, it probably varies drastically by business, but like what portion of your TAM that your ICP should be. But it shouldn't be 100%.
Right. I agree with that. It's just a more granular version of those two.
Great. When looking at these comp plans, we have this idea of metric X, which sounds like a X-Men or a Marvel thing. But tell me a little bit about metric X and what do you mean by that, Ryan, in here?
Yeah. So what are we trying to solve for? Right. We talked about CAC and margin, and maybe you're, hey, Ryan and Graham, like my CAC is great, my margin is great. Well, what metric is it? Maybe your retention and GRR or LTV could be better. So ask yourself in reviewing, like, which of my metrics am I trying to move the needle on and improve? And you don't necessarily need to be isolated to one answer on that either. But once you settle on one or a handful, then double click. What are the underlying drivers of that metric X, like that metric that you're trying to move the needle on for your business? And then, how much visibility does your team have into that? How do they understand how they can impact it? Do they ever understand the calculation of it? And that's what I will, go back and refer to that sensitivity matrix. But that has helped translate to the business of, well, I see this CAC and it's sales and marketing expense divided by logos, and it's not really computing. But if they see that laid out with two axes, okay, our new business either moves left or right. It either grows or shrinks. And same thing with our expenses. And I can kind of plot out, where I expect to land. And it's a tool that we use to translate, right? But when you ask yourself and you kind of settle on those one or two metric X's, now it's like, okay, well then how can I, what are the tools in my toolbox to go improve that? And what we're about to talk about is, well, your comp plan and your incentive structures is definitely one tool that you can use to move the needle there.
Awesome. Yeah. And I will drill into this and hammer you on this here in a minute. But when your metric X, when, you decide your metric X and how it can be kind of in competition with another metric that may be important, your CAC versus your margin, or your CAC versus your close rate, or things like that. So let's talk a little bit about some of the recommendations that I often give organizations when it comes to levers you can pull in AE comp plans. So I have a bunch of rules about AE comp plans. One of the rules that I have is that they need to be simple, logical, and fair. And when I say AE or account executive, I mean new biz folks, people who are focused on your new business deals. So simple, logical, and fair. And then you may say, like, well, Graham, you just said simple, and now you're recommending adding things. And that's fair. We'll talk a little bit about that later on in the presentation. But there are things that can be added that truly help you move that metric X. So, for example, if your metric X is centered around retention, a common thing that I recommend is encouraging multi-year deals. Now, I don't mean encourage multi-year deals by telling your reps, hey, go out there and sell some multi-year deals. I see that oftentimes where somebody says, hey, my reps aren't selling any multi-year deals. And I say, okay, well, why would they? Why would they sell multi-year deals? Oh, well, because it's better for the business. It's like, well, okay, but are you paying them more for it? Like, no, actually there's a baked in discount for multi-year deals. And so they actually earn less commission. It's like, well, okay, so you're discouraging multi-year deals there. So increasing commission rates for multi-year deals, or giving spot bonuses, giving a $500 bonus for every deal that comes in that's a 2-year deal. Or, hey, paying them for the total contract value. Depending upon your retention rate, it may be good for you to just pay and retire quota on the total contract value. The using higher commission rates for customer segments with higher retention rates. So again, if part of your ICP definition is these people are more likely to retain, we're more likely to retain these companies, well, you may pay 10% on regular companies, non-ICP companies. You may give an extra 2 percentage points on ICP companies. You have to be cautious with that, where you're not giving them 20% commission on ICP and 0% on non-ICP, to my point earlier about, like, well, then you won't know if your ICP is shifting. But giving a slight increase there to indicate to your reps that, hey, this is important for us to sell. Solving for gross margin, incentives for pricing protection. That has Ryan Messia written all over it. What do you mean by incentives for pricing protection there, Ryan?
Yes. So discounting. If your reps are selling deals at list price, do you give them, again, an accelerator, a kicker, a spiff, some kind of incentive there? I guess going back though, Graham, to the solving for retention and encouraging the multi-year deals, right? That would, I'm looking at that from a finance perspective. Well, if I'm giving them, a higher commission rate, is my CAC then going up? Yes. Right. Well, I thought we just talked about, we don't want our CAC to increase. Well, if they have a multi-year deal now, you're locking in, that retention, and you're essentially guaranteeing a higher LTV of that customer, right? So then putting that together, which is why CAC and LTV are often married together, in a ratio. And what I mean by that is, well, if a customer is gonna, pay our company $20,000 on average over their lifetime, but it only cost me $5,000 to bring them in, then I have like a 4-to-1, CAC to LTV ratio. And that's, you want to increase that number, right? So looking at it in the total lens, that maybe I am willing to pay more and increase my CAC a little bit to improve my CAC to LTV ratio, because I know it's going to be better for the business in the long term.
Got it. Yeah. And that goes to what I was saying earlier about, like, if your metric X is CAC, well, you have to be cautious of that, because then you wouldn't want to sign multi-year deals. You would want to sign shorter term deals, because you pay a lower commission rate on those. But that goes against the kind of the spirit of that. So sometimes you do have to understand that you have to give in a little bit on one in order to improve the others.
Yeah.
And then, decelerators on lower margin deals. Now, again, those might be ICP, non-ICP deals, something like that. At the beginning here, we also had a talk about cash flow, and cash flow is very important, obviously. You may be talking to companies out there who are like, oh, we have $10 million in revenue and 9 million of it is in accounts receivable, or 9 million of it is tied up in 3-year contracts that are going to be paid over the course of the 3 years. So I often see organizations, one way is, well, the second bullet there, which is payouts eligibility. So we did a survey, and the majority of organizations pay their reps when the deal closes, but there is a good subset of organizations. I believe, don't quote me on this, I believe it's about 30% of organizations pay out their reps when they receive the cash. Now that can be a pain to try to manage. Shout out to QuotaPath, because that makes it easier for you. But it also can be a pain for the reps, because they have to wait longer for them to receive their cash. And so oftentimes we also see accelerators for, or additional couple of percentage points for net 30 payments. The faster you pay, the higher the commission rate, or the faster the customer agrees to pay. That's risky, of course, because that you're giving them extra commission, and you're not guaranteeing that they're going to pay unless you have that payouts eligibility component.
Yep, that makes a lot. It kind of ties back to the concepts we talked about earlier. If you're default alive, you're flush with cash, or you have line of sight to profitability, maybe you're not trying to solve for cash flow. But if you're in a different situation, and you're counting on a fundraising round to keep the lights on, that it's going to happen in the next 6 to 9 months, then you may want to implement some of these strategies into your plan. Or maybe you want to wait until you receive the cash to pay out your reps, or you're going to be very protective of net 30 all up front. We're not going to split payments, right? You're going to have to hold the line there with your customers. Again, what are you trying to solve for? And pick your battles, and structure your incentives and your contracts, and negotiate kind of all to protect, again, your metric X.
Yeah. There's a question in the chat here, and I have a feeling I know your answer, but I'm curious. What is the optimal LTV to CAC ratio?
3 to 1 is the rule of thumb that I've always heard. So you want to be higher than that.
Wow.
And I think that's actually LTV to CAC. LTV to CAC. I actually misspoke before. I think I said CAC to LTV, but yes, it's LTV to CAC. How much is that customer going to pay you over their lifetime, and how much does it cost to acquire them, right? Just dividing those two.
Yeah. So the rule of thumb is generally 3x. So you want them to pay you at least 3 times what it costs you to get them. And that goes also to the CAC payback period as well.
Yeah, exactly.
If it takes you a full 12 months to pay back the CAC, well, then you need them to stick around for at least 3 years. If it only takes you 6 months, then on average, they only need to stick around for a year and a half in order to pay that, in order to hit that 3x ratio.
Yep, exactly.
So we also, when we talk about account management, we mean your new biz, or I'm sorry, not your new biz, your renewals and your upsell folks. And once again, solving for retention, a lot easier on account management, because you generally incentivize them based on retention. And I'm curious your thoughts of gross revenue retention plans versus net revenue retention plans. And you can probably do a better job describing the difference between the two than I can. But my rule of thumb, or the way that I've always described it, is your net revenue retention includes any upsells, whereas gross revenue retention does not include any upsells. It's more focused on like keeping the dollars you currently have.
Yeah, it's important probably to define the two. So gross revenue retention, how many customers or dollars. So it can be logo based or dollar based, but how much of a bucket is up for renewal in a certain period, and then how much of that did you renew, either logos or dollars. And then net revenue retention, same thing. How much is up for renewal in a given period, and then it's how much did you renew of that plus, did they add on more? Did they upsell into that contract, right? And that will give you your NRR number. So I think this is tricky I've seen a lot of broken NRR comp plans, I would say. And we're like, well, what do you mean by that? Especially in earlier stage companies, maybe there's not a huge cohort up for renewal, right? So it's very easy to upsell into that cohort, and you can break the comp plan. Maybe you can have 200, 300% NRR in a given period because that denominator is so low in that numerator denominator calculation. It's easier to move the needle on the numerator early on than it is, maybe in a later stage. So I always try to separate the two, comp them, some portion of their variable tied to GRR, and then have a separate, maybe flat rate, or, it really looks much more like a new biz plan at that point to comp them on upsell and expansion revenue.
Yeah, and that's oftentimes what I recommend for organizations, is to say gross revenue retention is 50, 60, 70% of your variable component. And then you have a commission on any upsells. Now, that commission can also be, you can have accelerators and decelerators. One of my favorite things is to have that accelerate and decelerate based on your gross revenue retention and within the quarter. Again, you do have to have a fairly consistent quarter over quarter or year over year, or month over month book of business renewing. But hey, you earn 5% of any upsells. If you're below 80% gross revenue retention, you earn 8% if you're between 80 and 90% gross revenue retention. And if you're above 90% retention, you get 10% on any upsells. And so that encourages people to focus on both simultaneously. It does add a little bit of complexity, but at least then I sometimes see is like, well, had a bad GRR quarter. I know I'm going to have a bad GRR quarter. So I'm going to focus in all of my efforts on upsells and cross sells. Well, unfortunately, you're not going to get paid as well on that if that's all you do is spend all of your time on that, because you have to have a good GRR in order to get a better rate. Much like on the new biz side, multi-year renewals and conversions, those are highly recommended, because if you renew somebody for 2 years, you don't have to turn around and have this conversation again next year. You lock that revenue in, and it's better for the company, and a lot of times better for the customer, because they lock in pricing for an extended period of time. When it comes to solving for gross margin, there are a couple other things that you can do here as well. We talk a lot about higher margin renewals. Any renewals that are on a higher margin, you can give a higher rate for. And over the course of the 12 months, but with new business, it's like, hey, we estimate, these types of businesses have higher margins. It's an inexact science, there may be an outlier, whatever. Well, with account management plans, you know what the margin is. It has been over the past year. And so you can give a different rate based on the margin for each of these different businesses. And then you're like, well, look, I'm maybe willing to, and tell me if I'm wrong here, Ryan, but I may be willing to sacrifice a little bit of my gross revenue retention by breaking up with really, really low margin customers.
Yeah, it's a great point. It is a little bit of a different lens there. You're kind of guessing on the new business front, and you're trying to incorporate some of those, discovery questions into the sales process to understand how much is this customer going to cost me. So it's questions that we're asking for our own business of how complex are your comp plans? What kind of integrations do you have? Do I have to go build a custom integration for you? That's going to cost me more. I'm going to be less, likely to discount, et cetera. But to your point, once they come up for renewal, you have, arguably some history of the support tickets that have been logged, how much time your team has spent on the account. So you're much more informed when you make that decision. And yeah, absolutely. I would be willing to, you always hear companies talk about firing their customers. But if you do margin analysis on the account level, and you understand the margin of each of your customers individually, maybe you do have to have those hard conversations and say, hey, either we're capping our support time or putting some kind of guardrail in place, or we're breaking up with you.
Yeah. Speaking of guardrails, we have 4 avoid efficiency pitfalls with these 4 guardrails coming up next slide. But there was a quick question in the chat that I want to address really quickly around spiffing on multi-year deals. So first of all, this is just a terminology thing for me. A spiff is a short term. The way that I define a spiff is a short term, like very catered, very specific thing. So like, for example, we have a spiff going right now. Our sales manager is going on maternity leave probably on Thursday of next week. And we said, hey, any deals that you close before she goes on maternity leave, you get an extra $100 on. Ryan, of course, made sure that it was at least to protect our CAC, made sure that it was at least a certain contract value and discount rate, but that's a spiff. Whereas part of their comp plan being paying on multi-year, I usually wouldn't recommend paying on TCV or total contract value. I would recommend paying on the ACV or the annual contract value. And I would recommend giving a higher rate on those if that's what you want. I actually talked to a customer a while back who they said, look, our gross revenue retention is like 99.8%. And our net revenue retention is quite a bit higher than that because we bake in upsells every single year. Every time I talk to a customer, I bake in an upsell with them. Now, do I want to encourage multi-year contracts there? Probably not, because then that customer is locking that price in for 2, 3, 4 years. You don't have the ability a lot of times. I mean, you can write it in the contract, but a lot of times you don't have the ability to have a price increase if something changes. So not always do I recommend that, but 95% of the time, if you can lock a customer in for 2 years, I would highly recommend it. And I would give your reps an additional additional commission rate on that. Now, what it would be, a lot of times it's like, well, hey, if our retention rate is that bad, I'll double your commission rate if you close a 2-year deal. That's pretty rare. Usually it's like it's anywhere between a 1.1 and a 1.5x multiplier on their commission rate. So if you're getting a 10% on a 1-year deal on the ARR or ACV, you may be getting an 11, 12, 13, 14, 15% commission rate on a 2-year deal. And then increasing it even higher for a 3-year deal. I tend to cap them on 3-year deals, not do 4-year deals, but each business is unique. There are some businesses where 3-year is default and they pay more on 4 and 5-year deals.
Yeah. And there was also a comment in the Q&A of, hey, these variables, a lot of these proposals are great, but we can't afford to, have a financial advisor explain to the AMs the compensation plan. I would say, again, we do have to keep it simple. And I would also challenge your RevOps or finance team to translate that. So they don't need to necessarily understand the calculation of margin on an account, but maybe it's, you have something simple where it's like level 1, level 2, level 3 support levels. And then they kind of just break that down of, well, tier 3 is this account takes a ton of support, therefore it's low margin. Tier 1, those are the ones we want. Those are higher margin accounts, or red, yellow, green, whatever. But it's, having to translate and break it down. Again, that's why we use tools like the sensitivity matrix, or, color coding accounts, tiering accounts, etc.
Yeah, definitely. And that's actually one of the pitfalls. So that's pitfall number 2. So first I want to have Ryan talk a little bit about understanding effective rates. What do you mean by effective rates, and why is it important for us?
Yeah, so effective rate is just how much are you paying on that deal, right? And there could be some blind spots that you may not be aware of, but kind of all in how much you're paying on that deal. And I'm not just talking about the commission rate or the effective rate that rep who sold it is receiving, but was there an SDR or BDR that's also getting a piece of that for setting a demo or setting a demo that even goes and closes? What about that rep's manager? What about that manager's manager, right? Is there a director? Is there a VP? What is that, what we call a compensation stack, right? And how much are you paying, and that will directly tie back to CAC and customer acquisition cost and managing that. Okay, we're willing to, add a spiff or add this new component to a comp plan because we're keeping our total cost of sale and our compensation stack in line.
Yeah. Do you have a rule of thumb for total commission stack?
Yeah, great question. It's going to, again, be very, business dependent, use case dependent. It's going to, matter of, again, it directly ties to CAC. So then the question is, well, what is your LTV on these customers? I think if you're in that 3, plus ratio range, you can afford, anywhere between, 20 and 25% of a total comp stack, right? So maybe that rep is getting 10 to 15 and their manager's getting, 4 to 5, and it kind of all in, you're paying anywhere between 20 and 25%.
Yeah. And I think that goes to the grow at all costs. Like, I had talked to a couple of companies where it's like, oh, we're paying our reps 25% of all the revenue that comes in. And I'm like, well, okay, there goes your whole commission stack. Like, and then the manager, and then the BDR, and then all of a sudden you're paying 60 or 75% of the value just in commission right off the top. Not to mention you have those base salaries and your CAC and all that. So it's important to track that effective rate. One of my rules is that comp plans should be like pizza toppings. You should keep it simple. Recommend no more than 3 different components. What I mean by that is, like, you've gotten those pizzas that have like all these different things on it. I live up in Maine, and people like to put lobster on pizza sometimes, which is like just clearly a trap for folks from away. And because you can't taste it. It's like, okay, well, I can't taste the lobster in addition to the garlic, in addition to all of these other things. Same thing goes for comp plans, where if I have 10 different things on my comp plan, my reps aren't going to pay attention to that. They're just going to say, like, okay, what is the most important thing, or how do I think I'm going to make my money? And they're going to focus on that thing. And so keeping it very simple, building a plan that is around that metric X, or maybe 1 or 2 or 3 different components to it.
No lobster
empower
pizzas.
Reps with visibility. Yeah, no lobster pizza. It's like, come on. I had a burger one time that had lobster on it. I was like, this is just ridiculous. You can't take lobster is a delicious food by itself. Lobster roll, fine. Anyway, don't get me started on this. Empowering your reps with visibility. Reps who have who use a tool to visualize their compensation. Again, quiet shout out to QuotaPath here. But they trust their compensation about 40% more than reps who don't have that. So reps who don't have any visibility into it aren't really sure they're getting paid right. Hey, maybe this is right, maybe it's not, whatever. Reps who have that ability to see exactly how much they are earning and how much they could earn trust their compensation 40% more.
It also, makes your finance and ops team's lives a lot easier, because they're not having to field questions from reps and break down calculations and spend a bunch of time, walking through formulas every single month.
Yeah, for sure. Shout out to the RevOps teams or RevOps folks on the line as well. So last thing, we actually, from a lot of those compensation plans those compensation consults that I've done, over 500 of those, took a lot of those learnings and actually turned them into a resource, totally free to use resource, comp.quotapath.com. Don't even need to enter an email address. It allows you to browse most trusted comp plans, and you'll see most of these are simple, logical, and fair. It also allows you to enter information in about your specific business, get some recommendations, and see exactly how much those commission rates should be and what my multi-year deals, what I should be paying them out at. So check that out as well. comp.quotapath.com. It allows you to model a whole bunch of cool stuff.
Yeah, no need to reinvent the wheel on this. Find your metric X. What's most important to you? What are you trying to move the needle on? We always talk about the saying of what gets measured gets managed. And we always like to say what gets incentivized gets influenced. So definitely use a comp plan. It is a tool you have in your toolbox. And if you have, proper plan design, then you can start to drive some outcomes.
Awesome. We have the classic questions slide here. I know we have a little over 5 minutes left. I see Angelica hopped on again. I don't know if you want to do any last minute stuff here, but I felt like we answered most of the questions during the session.
Yeah, thank you for that. And thank you everyone for participating and asking your awesome questions for Ryan and Graham. If there's any more questions, feel free to drop it into the Q&A function or in the chat. But that was awesome. Thank you so much, Ryan and Graham. And thank you everyone for attending. Graham, lobster and pizza, that's very interesting. I'd have to go to the East Coast and check it out. I'm a huge seafood
No, you
fan, but
shouldn't. It's not
no.
not great. Not great. No.
Stephanie, yes, there will be a recording, and the presentation that Code of Path created will be made available on the MSP website before the end of the day, as well as the key takeaways. Thank you, everyone, for attending. That was an awesome session, and we will see you at the next event. Thank you.
Thanks, everyone.
Thank you all.